Sure, sellers don't appreciate that at all. What are we talking about? What's an add back? What's EBITDA, right? Every buyer talks about EBITDA, earnings before interest, depreciation, and amortization. It's not something that a seller, an owner of a business runs his business towards, but it's exactly what a buyer is looking for. So now they have to create a metric they've never used before. And then we have to adjust that metric. We're talking now, not EBITDA, but adjusted EBITDA. And then we're talking about the add backs. And what is an add back? How do you normalize the business? So there might be certain expenses that they're incurring today. So maybe they're paying themselves an inflated above market salary.
There's a lot of sellers out there, high quality deals you're looking at. I mean, you're looking at, given with the kind of companies you work for, you're looking at very profitable, long-term family deals, but it's competitive. It's been competitive for a long time. I mean, I would say the market's been highly competitive, a seller's market for at least the last 10 years. You worked what we call from a strategic buyer, right? It's a lot of similarities, integration versus a private equity buyer. And all we hear about in the market today is PE firms are buying this, PE firms are buying that. Going into selling your company without a team supporting you, I wouldn't recommend it, especially an investment banker. I mean, you need someone to be your point person, right? It's kind of like take all the inflow from the buyer and then parse it out in a way that you are comfortable, reacting to it. So why do they need this? What's all this about? You want them, I want you to ask me all those questions so I can respond to you and explain to you why they're looking for this and why it's important for the success of the transaction. I've had many, many, many phone calls over the year where our clients got very frustrated and they called up, screaming and yelling. You need to broaden your horizon. Maybe it's strategic buyers that are in a industry that is close to yours, but not directly in it. That kind of buyer wants to get into your business, but currently doesn't have an avenue for it. And they think the best way to accelerate their strategic plan is to buy a company in that market. And typically those type of buyers, those type of strategic buyers will likely pay higher multiple or greater value because they need to get into that marketplace.
Congress passed new legislation about how they were going to fund, finance, and provide tax benefits to certain parts of that industry. And the business dropped in value by about 60% overnight.
Right.
Because Congress made a decision. So the deal was done. The gentleman is back working in the business, trying to build it back up to get it to a point where he can, in fact, exit.
You don't know what you don't know. First time transaction, only time transaction is that when you learn a little bit more from the buyer, what value they bring to it, the kind of light bulb goes off and said, you mean I can focus on the fun stuff and not so much on human resources or dealing with the insurance or dealing with the more important issues, but more, the owner would say mundane issues, right? Things that have to be taken care of, compliance issues. But I can focus on strategy and growth, things like that. You can get excited about it. So what does that mean? What's a fundless sponsor? Well, that means that they have a fund, but they have no money. They raise money for each deal. So if you pick up the phone and you talk to somebody who's like, I'm so-and-so capital, you say, are you committed fund? That means that they've already raised the money, again, from like the California pension plan, New York pension plan, other investors. They're sitting on committed capital of $500 million, $1 billion. They're ready to write that check and make a deal happen. If they're a fundless sponsor, they have to go out and do a road show. They go out and have to raise money for each deal, specific deal. So if you're talking to somebody who's looking to buy a company and they haven't done a deal in the past, what is the likelihood they can raise the money to make this deal happen and finance it? If they don't have that money in place, you need to be very suspect about their ability to close. Certainty close is paramount. First time in 20 years, this is our 21st year, that there was actually, I didn't have like a deal in some stage of process that I had to be like on call 24/7 I had my phone with me, of course, if I needed it, but it was like 4 days in over 20 years where I didn't have to be on high alert, so to speak, versus if it happened, we just closed a deal earlier in the month in April. If it happened 2 weeks earlier, I would have been on my phone the whole time, right? So as you say, just being available to your clients 24/7 is critical.
What you don't know as a seller is the buyer's intention. Is this a nice to have or a must have? You don't know, right? So I might provide an indication of interest in the form of a bid. But you don't know if I really want this. How excited am I about this opportunity? But my bid might be high enough to get me to the table. And that's what I kind of want, just like private equity. Get to the table and really do a deeper dive to see if this is a must have versus nice to have. And when I do get to the table, being invited to a management presentation, or I get to meet the ownership group, or I get to meet the senior management, that's when I'm starting to get excited about a transaction. And from there we can determine, is this a fit?
What statistically, less than 25% of businesses transition to the second generation, and less than 13% go to the third generation. And that's because they have their own lives.
Yep.
And you sent them to college if they wanted to go to college, and they decided they want to be a psychiatrist or a social worker or a doctor or a lawyer or engineer, whatever. And so I want to live my life. Another thing I think what comes down to is that they see over the years what you've done and how you lived your life running your business, and they're observant. They're your kid. They're like, I don't want to do that. Yeah. Right? Yeah. I don't want to live my life that way. I want to have fun. I want to separate. And it's a generational thing.
Is that you can mitigate some of this fear or anxiety by you bring in an outside firm, whether it's your current accounting firm or you bring in somebody, a transactional firm, and you have them do a sell-side quality of earnings. So you want them to kind of look at your financials and poke holes in them so that you could take corrective action before you go to market. I mean, there's nothing more important, no surprises, reducing that level of skepticism when you go to market. That is more critical. You understand why they need to do this. And then, of course, the buyer appreciates what your concerns are. Because they don't want you to be in an adversarial position when you close the deal. It's not good for them. It's not good for you. Likely, if you get that position, you're going to probably back away and say, look, you're not the right fit for me. I'm going to take it off the market and I want to rethink my process. So they have to, it's like a delicate balance. Your emotions are running high. Their emotions start to run high. So, it's the whole communication piece is really critical to success.
For us, the intersection of the business and the personal financial plan is where the magic happens. So we said, well, let's see, if you sell that one business, you'll have an influx of cash that will allow you to hire the appropriate leadership on this other business, a CFO, head of marketing, head of operations, that would allow you to spend more time on the boat with the family. And maybe in 10 years, Junior could come in and take over the business, or maybe not. Now you have a strong leadership team that could perhaps take over the business.
So there's several different types of private equity firms, and there's several different ways they work. So essentially, a private equity firm is a company that is backed by institutional capital, like CalPERS or New York Pension Plan, et cetera, and they invest that money on those investors' behalf and look to make a return. So they're looking to buy the business and hold it for a specific time. It could be 3 years, it could be 5 years, it could be 7 years. But there's definitely an end game. They have a fund they're looking to invest. That fund could be a $500 million fund. It could be $1 billion fund. It could be $1.5 billion fund. It could be bigger. But at some point in time, they need to realize in their investments because they need to return that capital back to their investors.
So, reputation as a buyer is very critical. And you get deal flow because of that reputation. So if I walked into an industry trade show, and I've already been quite acquisitive, people would know that. And so if I show up at a potential business's potential acquisition exhibit booth, they are either very excited to see me or they're not interested they're not for sale. But if they know who I am and they know my reputation in the industry, That's a very powerful advertisement for doing transactions.
And you may think the number is more like 15 or 20. In fact, there was a situation years ago where they thought they needed 20 million, and their advice said you need like 8, in a very conservative method. So, and then a good wealth manager will not just look at your needs, but they will take, things that benefit you afforded yourself throughout your company, those quote unquote discretionary expenses. They now become a personal expense, right? A good wealth manager is going to not only look at what you've taken out of your business, they're also going to look at a number of items that run through your company, right? Some of these things you've afforded yourself, like quote unquote in the trade, discretionary expenses. And they're going to factor in because those are going to become personal to you after the sale.
So, reputation as a buyer is very critical. And you get deal flow because of that reputation. So if I walked into an industry trade show, and I've already been quite acquisitive, people would know that. And so if I show up at a potential business's potential acquisition exhibit booth, they are either very excited to see me or they're not interested in me. They're not for sale. But if they know who I am and they know my reputation in the industry, that's a very powerful advertisement for doing transactions.
Having somebody who's been through multiple transactions over many years, can help you guide and help you, kind of give some clarity to these unknowns, these uncertainties. I always say we've seen everything, but every deal's different. And as I always say, there's always something on the table that we didn't think about, right? Because everybody has their own personality. Everything's different. And so some things come up in a transaction that need to be addressed.